Today, we're going to talk about why gross margin or gross income is a complete metric for the most part when evaluating a company's valuation in relation to its stock price. We'll be evaluating a couple publicly traded software companies and making our case that this is a metric and why you, as a long-term investor, should be more focused on operating income. If you're a new investor and you don't know what gross margins are, don't worry because we'll get into that too. Welcome to episode 6 of the MegaCharts stock analysis channel, where we use MegaCharts software to evaluate stocks. Normally we evaluate individual stocks, but today we're switching things up a little bit and talking about an actual metric. Now, before we jump into things, I do want to highlight that within the MegaCharts platform, we do track gross income and gross margins. With that said, even though we provide that data, I almost always ignore it when evaluating stocks, and I'm going to tell you why. Gross margins, in my opinion, are a lie that software companies tell to venture capitalists to explain away their unprofitability and sell them on a dream of higher margins at a later date. Allow me to explain. Gross margin essentially is an incremental cost of delivering another unit of service, or so they say. If you're selling a software product like Salesforce, MongoDB, GitLab, etc., the only costs that are going to be included in the gross margin are, number one, the cloud hosting fees, because all of these companies have to pay the big 3 cloud providers to run their software, and direct support costs that don't include sales and account management. What is not included in gross margin are operating costs. Operating costs include research and development, sales, marketing, and all of the other miscellaneous administrative costs that occur as you grow a company. And here's the thing, every software CEO out there has relatively the same pitch to investors from a balance sheet perspective. They all claim that revenue and gross margin will grow exponentially while operating expenses will grow linearly. They claim that as the business gets larger, they will need to spend less on R&D and that acquiring customers through sales will get cheaper. Let's break down the claims here one by one. First is the R&D expenses. These will never come down for a software company, especially a good software company. If a company wants to stay on the cutting edge, it always has to spend a reasonable percentage of its income on R&D. Tech is perhaps the most competitive field in the world, and there are always going to be upcomers rising through the ranks funded by ambitious venture capitalists. So if a company becomes an industry leader, they're going to have to stay that way by, continuing with R&D expenses. So R&D costs will scale with revenue for any serious software company, and there's a very few exceptions to that rule. Now let's talk about sales-related expenses, and this is something that I know about because I've done B2B software sales for a while. As companies grow larger, they shift more focus away from acquiring new customers and towards gaining more revenue from existing customers. This is why net revenue retention is such an important metric. With that said, gaining revenue from existing customers is not cheap and it's not easy. The more customers spend, the more detailed account management they need, especially if you're going to upsell them. So if the average customer spend is $50K, then sure, an account manager can manage 70 accounts. But if the average customer spend is $500K, then account manager can maybe manage 7 or 8 accounts. And that's honestly on the high end. So essentially, you're going to have to hire more account managers, pay them all a salary, and if they actually increase the revenue from the customer, you're going to have to pay out a commission. Then let's talk about administrative costs. Regardless of what anyone says, these costs do not go away, and they definitely scale to a degree with the company's revenue. With more people at the company requires more HR resources and more operations resources to coordinate all the teams. Let's look at Salesforce, which is a very, very mature tech company that's over 2 decades old. You can see that finally in 2023, their operating margin jumped to 5%, but for several years before that, it hovered at around 2%. And looking at Salesforce's actual operating expenses, you can see that they grow pretty consistently with the trajectory of revenue. Now, if we take a look at Microsoft, which is even more mature than Salesforce, we can see that the pipe dream of super high margin actually pays off. But here's the thing. Number one, Microsoft is 48 years old. And they didn't have these type of margins until much more recent years. And number two, Microsoft is Microsoft. There's really no other software as a service company comparable to them. Bottom line, most companies don't even make it to Salesforce's stage, let alone Microsoft's stage. And you're talking about a 48-year time horizon, which is why it's really important to pay attention to operating income and not gross income when evaluating these tech companies. Every time a software company is reporting their earnings and they talk about gross profits, double check and you'll probably find that they're actually losing money. So full disclaimer at the end of the show, this show is not financial advice. I'm not a financial advisor. If you want to be a responsible investor, you need to do your own research. If you want to get started researching stocks for free, check out MegaCharts.com. No profile needed. You get immediate access to the data. Thanks for watching and peace out.